All right, good afternoon, guys. Welcome to the private webinar for Thursday, February 8th, 2017. How's everybody doing today? Another thousand point down day in the Dow, correct? So what I purposely, I kind of had a feeling that we would close around the 2600, and I wanted to talk about the H pattern today and what I think is going to happen tomorrow, and then we'll see, some ideas of where we're going to go for next week. Let's turn screen sharing on. Okay, does everybody see the quad, right? Got it? All right, cool. All right, so the first thing I want to talk about is what I call the H pattern. The H pattern is kind of hard to resolve. What it means is you're going to have, look at the SPY on the daily. Okay, and it simply means that you have this letter H. And notice that, we came right to the 50% fib, backed off, and it's forming like a letter H on the chart. So if we make it like bigger, okay, hold on one second, guys. So if you can imagine, it's kind of like this. This is what forms the letter H. And usually what will happen, and I've seen this happen before, is you'll have some time spent in and around here because it's hard to resolve. Usually like people who short the low of the H pattern, so like right here, they kind of always get hurt. And I learned this the hard way, always thinking that the breakdown to new lows was a short. And then I learned much later on that it's not. And the reason that it's not is the concept that is another ShadowTrader concept. And I don't know if this stuff is original or whatever, but I mean, I just come to it of my own education from Hard Knocks, which is really the best way to learn anything in the market. Because then, if you just read stuff in books, it's not the same thing. You really have to get in there, lose money, and then it sinks in, or get in there, lose money for, a lot of times over and over, and finally be like, okay, I'm never doing that again. This does not work, right? So that's why I sent a tweet earlier today that I said, I think that what happens is that we trade wild overnight and we actually gap up a little, and then we kind of come in and we're going to spend some time resolving this 2600 in the S&P cash. That would make sense. We close at 2581 down 100. Another reason why I think that this is going to probably come to fruition is understand that the SPX, or rather the Dow, lost 1,000 today. And usually after you have like the big 1,000 down day, like we had here, for instance, right, you get some sort of counter trend move the next day, right? You can see that you had it one day and then you had the green day the next day and then even up more. So anyway, suffice to say, I think that we trade in some sort of range around here, okay? So that's the H pattern. Does anybody have any questions specifically just on the H pattern? It's not really all that complicated. It's just a good pattern to know. It really is. It's a good thing to be abreast of and know that it exists. And whenever you're in a market, for instance, you see a support level and you want to short the support level and you come down a long way into the support level, don't short the support level because you've already come so far that at that point there won't be new sellers to join the party underneath that support level. And that's the problem. You need new sellers. So that's why the best place to initiate a short is always kind of above or into a resistance point, or if the bounce is minimal, meaning you come down to a support level and you get a bounce, you get some sort of retracement, and then you can short. Jennifer says, how long does it stay in that holding pattern on average? On daily charts of the cash, honestly, it can be a week or more. I've seen this before. Mike is asking the same question. I've seen like a week or more. So I wouldn't be surprised if next week is relatively choppy and we stay somewhere around the 2600. And that is the reason why those of you that are in the weekly time spreads advisory, I put on a risk reversal with a butterfly next week that is at the 2600, 25 points wide, straight butterfly, no risk to the downside, risk to the upside only if we take out the 61.8 retracement on the fib, right? So I'll put that back up there. So notice the 61.8 here. This is where the risk is right here above the 61.8. and then there's no risk to the downside. However, we would like it to stop right at the 2,600, right? We would like the market to be in here somewhere. And because this is put on for relatively low cost, like 60 bucks or whatever, it's zero. We have 8 contracts risk up here, and we have 3 contracts long down here. Since our cost is almost zero, right? To be honest with you, all we need is a couple days of sideways, let some volatility eke out, let some time go by, and we'll be looking to probably get rid of these starting at $3 and then probably $5 and maybe $7. Even though it's a 25-point spread, remember that when volatility is a little bit jacked up, it is not going to trade inside. It's not going to trade anywhere near max value for a while. So what's interesting about this spread and why I purposely put it on that I like so much is, do you guys understand that if a butterfly looks like this, right? And let's just say that we're happy with making $5 on it, right? Do you guys realize that this is 2,600, right? Do you realize that if you just want to make $5 on this spread that you bought for nothing, in a week, all you have to do is stay between 2,620 and 2,580. Anywhere, if we land, right? Do you understand? Anywhere in there, like let's say you at the end of the week we're at 2,620. It's worth $5. Let's say at the end of the week we're at 2,580. It's worth $5. Inside of 2,620, 2,580, which is a 40-point SPX range, right? It gets even more expensive in your favor. Now you're talking $6, $7, $8, $9, $10, $11, $12, $15, up to $25, right? So you've got a very large range here to make money, and it makes sense when you put the spread on for free. So that's why I put that spread on today, because my thought is that we'll, at the very least, we're going to trade somewhere in that range between, say, roughly 26.25 and 25.75 over the course of the week. And again, because we have it for almost zero cost, it doesn't matter what we get, right? As long as the market doesn't bounce all the way up there. And if you look at this daily chart, I don't think that's happening. I mean, we'd have to take out today's high and take out the high of the other 1,000-point Dow day and break the trend, right? I purposely have the risk above the trend line, all right? Sandra and Randall says, I didn't get filled. Is it still valid? Okay, listen. This is very, very important, guys. You must understand that if I send out a trade via text, it definitely means that I'm in it and I like it. If it doesn't say working and it says BOT, which is most of the trades, they say bought, sold, okay? And I remember that when I texted it, the market actually still bounced a little bit for a few minutes after that, so it could have easily been put in. You have to be willing to penny back and forth on the prices. I am cutting and pasting the fills from this live, from a live Thinkorswim account, right? That's all this stuff here, correct? But if you understand that prices are moving all the time, and especially if it's a complex spread, right? If I say that, you know, if the platform returns that, not say that we did, you know, that we bought the spread at $1.40, and think about it, you're talking about, let's say it doesn't fill. We'll go $1.50, $1.60. You have to understand what prices change the dynamics of the trade and what prices don't. You know, paying $1.60 for a 25-point wide butterfly versus the $1.40 has absolutely no material consequence. That's meaningless. Now on the other side, we're going for, I got a 45-cent credit. I saw the credit go all the way up to 60, right? I wouldn't buy the BWB for like a 15-cent credit, right? Let's say the market started to get away from us. I'm like, okay, forget it. It's not happening. Usually on a credit, I'll take no less than 40. So 40, 50, 45, 50, I'm okay. But anything below that, I'm like, it's kind of dicey. I don't want to have like $5, $10 risk. Doesn't matter what direction it is, just to get, 30 cents. I need to get at least 40 to 50 cents. All right. So that's very, very important to note. See, Brian from Boston said I had to nickel down on the calls and nickel up 3 times on the put. Well done. That's how it should be. John says you got 40 cents. Good. Jennifer said she had to pay up on the put side, but got price improvement on the call side. I find I usually have to work these. Exactly. You do have to work them. Remember, though, guys, unless I say working, unless the text says working, then you just put it in there, leave it working, and don't penny up or penny down. The next text you'll get from me, if I decide to change the price, I will send a text that will say, you know what, this isn't happening. Cancel. I canceled and I took 20 cents less, or whatever the case. All right. Okay. So that's that. All right. So we're done with the H pattern. We're done with SPX on the risk reversal. Also, at the end of this webinar, I'll do it at the end so that I don't waste time of people who have it down. But this one gentleman was emailing me today and asking for sort of a how-to class on how to enter the spreads. If anybody is listening who is still a little bit confused about how to enter orders, I will spend 10 to 15 minutes at the end of the webinar, and you'll see I'll put them in live on the platform, and we'll put in different types of orders. All right? So just to go slow. Yes,
Peter,
Scott.
Just to give you a reference, where we finished today, and I just want to reference everybody, a 10% correction on the Dow brought us to 23,955, very, very close to where we were today. The 10% correction on the S&P 500, 2585. Guess where we are right now?
81.
81. All right.
Yep.
And a 10% correction on the NAS, 6755. So we've hit targets that were out there for a good corrective phase in this big run-up that we've had since about a year and a half ago.
Well said, Scott. And I want to just add Scott's comments on to what I said at the outset of the webinar, in that I think tomorrow will be sideways around these levels. I think that we gap up a little too, because usually if, that 10%, I'm completely agreeing with what Scott is saying, that usually that 10% marker is an area where the market has difficulty going lower before it bounces. Right. So you put those two things together with the H period, and here we are. All right.
Okay. The other side to that coin is we've come down very hard to that 10% correction. Now we have to build confidence back in the market to build value once again. So Peter's comment that it may take a week, it may take 2 weeks. So you've got to build that confidence over and over and over every day for this market to go back up to those highs, for where he's got those butterflies pegged and that downtrending line needs to be taken out. It's going to take some time to build that confidence.
That's right. So that's why it made sense to me that both sides of the trade make sense. It will be difficult for the market to get up there, and I think it will be difficult for the market to get lower. Even if the market does push lower, like let's say we go to 2560 or something, I'm pretty sure that over the next 3 or 4 days, we will pop back up and retest 2600. If we pop back up and retest 2600 on like Wednesday of next week, do you realize that a 25-point butterfly at the money is trading for like $6 to $7? So it's a really solid trade, and you paid zero. So the trade just made a lot of sense to me at the time. All right. Okay. So we've talked about the H pattern. We've talked about the SPX. The COG is still open for tomorrow. We've got the put protection on it. So worst case scenario, that's going to lose a couple $100. It's only a 3 lot. But I'm watching that closely. I'm a little bit disappointed with how that traded. I think the market weakness just kind of took over. I thought that the natural gas was going to bounce. In reality, if you look at this, I'll show you something. This is where I was looking at the bounce.
Hey, Pete, turn the camera off. We can't see the bottom screen.
Okay, no problem. Thank you, Scott. This is where we were buying the COG. So it made perfect sense. I thought that energy stocks might get a little bit of a lift, and instead natural gas just lost it right through there. And if you go to the weekly, now you can see it's not going to have support now until here, more or less. So the COG trade might be a bust, but again, we have it made good sense to put on the protective put for 30 cents, because obviously we don't want to be underwater multiple dollars. Usually if I have a stock play like that, because this is an options advisory, you'll notice I'll try to do like a protective put. We did that with that, what was it? The Scott was a mining stock, I can't remember the name of it. That's that mining stock that we did because we had something on the gold miners. All right.
I'll get it.
Yeah, it doesn't matter, Scott. It's not important. I just couldn't remember the name. That's the thing with stocks is really it could be XYZ, ABC, or whatever, triple X. It doesn't matter. It really doesn't matter.
ABX.
What is it? ABX, right?
Alpha Bravo X-ray.
Thank you, ABX. But it doesn't really matter. We're trading patterns. We're trading volatility. We're looking at what Greeks are doing. We're looking at what volatility is doing. You know, it really doesn't matter much. All right. Amazon going out is probably going to go out at full value for the extra calls that we sold. So that'll be a decent trade. That's trade number 104. I'll mark it closed tomorrow, and I'll just send a text saying that the calls had gone out worthless. So I think that made sense the way we did that. That was a little bit. Did anybody notice on Amazon over the last couple of not today but yesterday how dicey it was? That like Amazon looked like it was really strong. Did you guys notice that the spread was kind of losing value up in here? I didn't think there was anything to worry about, and I didn't touch it because it just felt like to me like Amazon was struggling. Like it tried to go up here, failed. It tried to go up a little, failed some more. It just kind of made sense that it was going to stay underneath. I personally didn't think the market was going to sell off this hard this quickly. So what I thought would happen is that since Amazon was showing some relative strength early on, like more in this area, I thought maybe it would hold that sideways, and then this big spread here would expand with the 132 that we have, but I guess not. But anyway, this is the reason why when I have a directional butterfly, like, look, this is the direction I want to go. And if the stock doesn't seem to get there and it looks like it's going the other way, then immediately start adding the verticals inside, right? Oops, +1, right? Immediately start adding the verticals inside to turn it into a BWB, right? Because you can feel pretty safe with that because you're still anchored by the +1 at the bottom. So all you've done is just turned it into +1 -3 +2, right? So me personally, I always feel pretty safe whenever I have a long in front of a short. Everybody, I think, has to trade according to their own personality and what they're comfortable with. And I've said this before a while ago, like in different videos or whatever, but I'll say it again to you guys. I am not good at all with this. This does not work for me. Like I just don't like the market moving towards options that I'm short. And that's why you hear me always talk about ratio spread. And in this advisory, I purposely toned it down a little and I stopped doing ratio spreads and I just started doing them as BWB and unbalanced, because I know that generally the average trader doesn't have the margin capability to do +1 -2, right? So yes. So, all right, so Amazon worked out well. COG we talked about, and now we only have, that'll leave us with 105, which is the XPX. And again, for next week, our target on that literally is going to start at like $3 to $4. All right. Brian from Boston, they are going out worthless, but I hope you understand that we sold an 8 lot of vertical inside of it. So we have a decent net credit there. So that trade turned into a winner. All right. Let me get in. Marty says, if you have the margin, do you prefer ratio spreads over the butterflies? Most definitely. Yes. Yes, most definitely, Marty. I like ratio spreads much better. There have been a number of mathematical studies in like some of these more esoteric option things that are out there. You can just search for it on the web. I don't really know any, and I can't really remember specifics, but there's been a number of studies that show that mathematically, like a huge percentage of the time, the third strike that you're buying, the one way out, it's worthless. It makes no sense. Like how many times the outside strike on the butterfly goes worthless? Almost all the time. Like it's just, it doesn't make sense. Like if you're going in a certain direction. I mean, obviously there's going to be times where you blow right through it, whatever, but you know. All right. All right, so that's H pattern, that's trades. Let's talk about new trades, about new ideas. I don't have many because what I think is going to happen here is we need for this, we need for the H pattern to resolve. So SPX 2600 is going to be good. I may be looking at some, what's the word for it? I may be looking at some iron butterflies next week. And why would I be looking for iron butterflies? That's a kind of a quiz question. Why would it make sense to enter into iron butterfly, like say next week?
Can I answer? Can I answer?
Yeah, you can answer, I guess.
No, I'm not. Okay.
What is that?
I'll give you my heads up. And
you're a little bit crackly.
I'm a little bit crackly. Okay.
Mm-hmm. Yeah, Bruce is right. It may go stagnant because not only that, Bruce, but you want to put it on when you have high. Exactly, Kyle is right. You want to put it on the highest volatility possible. So, you know what's another good strategy too is like collecting premium with butterflies on very very high vol. I don't know if you guys have ever noticed, but butterflies trade very very cheap when the vol is high. So you could get like a 20-point wide butterfly like in Amazon for like 80 cents or $1 sometimes. And then if the vol crushes, right? And then the same thing with like the iron butterfly, it's cool because you're selling at the money, big verticals at the money, right? And then you can see like with the vol pumped, now the verticals might be 20 wide and you might be getting 17 bucks. So you got such a huge, the odds are so with you that inside of there, that thing is going to collapse down to 15 or whatever. So we'll probably be looking at some of those next week, like if and when the market calms down. So we'll also be looking at next week, expect to see some put sales. So for instance, in the S&P, this is also what I wanted to show you is look at this. All right, here's our S&P channel at 2520, and that's not that far away. And this is what I think is going to happen is I think the market's going to kind of dribble down to this area more or less. It's going to like resolve the 2600 and come down about 60 or 80 points down into this area. And then we have a playable bounce. And if we get here and we can see that we have, volatility very jacked up, like right in here, right? Well, that's going to be great because we're going to be selling that volatility. We're probably going to do risk reversal to the upside. So that would be cool, right? So that's something that we are definitely going to be looking at for next week. So expect to see those types of plays. And also notice that on this weekly, this is also the 50 MA on the weekly coming into this area. All right, so that's kind of interesting as well. And the percentage move down here would have to be like 12%-ish. It's huge. So we'd probably be looking for a turn there. All right. Okay, so that's the technical outlook. That's SPX. Let me see what our situation is in the rut. Rut has broken this trend. I think Russell could still come in a little bit. And NDX is also going to probably, bounce a little bit here on trend. Right? Look at your weekly NDX, right? It's right there. So like even if we were to test this tomorrow, look at the prior lows here. You probably bounce pretty hard, and I'm going to guess you're going to close somewhere a little bit higher. All right? That is the technical. All right. Mark says, what do you think about back spreads, which is short one in the money put and long two out of the money puts in a correction? Is volatility too high? Yeah, that doesn't really make as much sense in high vol because you're paying a lot, Mark, for the two that you're buying. I mean, I understand you're selling that one at the money. Really what matters most for back spread is that you have to be sure that you're going to have a big move, a big move. All right. You have to be sure it's going to be a large move. That's really the time to do 1 by 2. And you want to do the 1 by 2 like as wide as possible of an area that you're comfortable with, where you're sure that the stock is going to overcome that area. So like, let's say for instance, like that's a really good question. Like down in here, maybe we consider that, but I don't think so. Like, I don't know if I would do back spread here, right? Does everybody understand what Mark means by back spread? So back spread is, you know, I talk about ratio spread a lot. So let's say you're going up on the call side. So we're going up, right? So ratio spread is like this, +1 -2, and you make money in the middle here, right? You make some money here, but if it goes too far, you lose money. But then back spread is the opposite, is -1 +2, and you want the market to drill really hard to the upside. And obviously you lose this much money here, but as soon as you cross this, you start making money. And where does it really make money? Well, here, right? Because it's got to cross the butterfly line, right? That's where it becomes a butterfly. Like here, this loses money at the point where it becomes the butterfly. It makes money all inside here, correct? And here, you start making the big money as you cross this, because for every one of these you're short, you're 2 of these long. So you only need half the distance here to make up for this full distance here, right? Yeah, exactly. I agree, David. That's why I was saying as well, is that I agree with what you're saying, is that the back spread is a long Vega play. And think about it, if you're coming up, you're expecting volatility to crush, so you don't really want to be long Vega that way, right? Vega is the sensitivity of the options that you hold to percentage points of vol, right? As vol ticks up or down 1%, 2%, back and forth, right? The Vega is how much is going to be the impact on that. So David brings up a good point, and that's what I was kind of alluding to that earlier. I agree. It's probably not a good idea in that sense. And remember also is, and I think it was Mark who asked this, is that if you were to buy calls if you are on the downside, right? Remember, because this is a classic rookie mistake. Be very careful with buying straight calls. You want to spread them off, because remember, you're buying calls in high vol. Like, I'm sure you guys have heard this story over and over again, but it bears repeating because some of you are new and maybe you don't know this, right? If you buy calls down here, let's say a little bit out of the money, you understand that the market could rip to the upside and you could make no money or lose money because of volatility. Like, you could literally be buying an SPX call that's $20 out of the money, like over here, like far away, paying $30 for it. Okay, now the market has to rally 50 in order for you to make money, and you're not realizing that extrinsic value in the call at $30 is ridiculous. That if the VIX was at, 15, that call would trade for $7 or whatever. It's ridiculous. So you have to be very careful of that. So you want to try to buy those either deep in the money or spread them off, or as I like to do, risk reversal. Risk reversal makes the most sense because whatever you're buying on the call side is offset with premium on the put side. The whole thing costs nothing, and all you need is for the market to bounce a little bit, right? You guys will notice that my MO is generally that I don't really think of the big move that much. I'm really just happy with just making the small move, and I don't really trust the market as much as I should. That's probably an Achilles heel of mine, right? Is I'm more interested in thinking, okay, I know that it could go from here to here, but in general, like, the odds are pretty strong that at the very least it's going to go from here to here. It's going to do this, and I want to be in a spread that's going to profit, even if it just does that or whatever. And if I see that it's not going to do even that, then we sell more premium and try to just bring in revenue that way. All right. Okay. Good. Very cool. All right, we're blowing through a lot of good stuff here. By the way, futures are rising overnight, which I'm not surprised. We're all the way back at 2601. And lo and behold, that's exactly what I texted. I tweeted. I said, I think it's going to be wild overnight, and we probably, resolve the 2600 tomorrow for what it's worth. Some people are talking about NVIDIA, I noticed, and NVIDIA did report earnings. Seems like some good news. Stock is trading at 242. That is good for the NASDAQ, right? So you probably see, let me see, NQs, hold on, NQ, yeah, NASDAQ futures lifting a little bit, but There will be some options play probably here for the Friday. So that's interesting because they're going to go out here. What might be an interesting play is maybe a 1 day. You guys see this? Like, put this on tomorrow. No, I shouldn't say that. Don't just put it on blindly. I'm saying watch this tomorrow. Let's say the 250, 230, right? Now look at how big that is. And when I say big, I mean like it's good. Like look at it. $20 wide iron butterfly with 1 day to go. If I could get $16.50 for that, I would sell that immediately with 1 day to go. And then basically you're gambling on the fact that you're going to stay in that range. So, and usually when stocks gap up big, they don't end up going anywhere. Usually they'll just go sideways, especially if you look at where NVIDIA is, right? Look at 250. 250 is here, right at the all-time high. So I think it may have difficulty resolving that. Now, obviously, if the stock opens above that and just starts to rip immediately, you may not do this, or you maybe do it higher. Maybe you sell the iron butterfly around the 260. But it makes a lot of sense, this play, because you not only are betting on a smaller than expected move during the day, but the fact is, and this is what a lot of people miss, is a lot of people think that the huge vol is only the day before. And I understand that much of it is going to crush. Like over here, you see that this is 151% right in here, 151.65%. Huge, right? That's huge implied volatility with 1 day to go. Now, obviously, that's going to crush a lot, but it's going to crush even more after 9:30 and like keep going. All right. David Stewart, who is in the chat, is very knowledgeable about this trade, and he and I have kicked it around a number of times on different spreads on this. So, all right. So keep an eye on that. We may or may not do that tomorrow. We'll see. All right. Let's talk about some ideas. A couple of things coming down to support that I think are interesting. I made a note on ISRG, so you may want to make a note for yourself. Look at the 360 level in ISRG. This is IBD 50. Then also Align Technologies has horizontal support coming up. These are great companies. I think they're just getting hammered like with the market. And then I also made a note on OIH, which is oil services. And I was thinking that there is trendline support here. This is what I think is the better play, because usually it'll have a tough time resolving this area. I don't know about the trendline support play. I think that's probably not going to work. Like if you look here, this could probably go lower, break this, but somewhere in here, I think there'll be a long bounce. And because you see the trend is really still up in CL, and I'm thinking that at some point it will kind of bounce like that. We'll see. All right. So that's that. Okay. That's really everything that I wanted to talk about. I'll do the spreads at the end after Scott has his turn. Does anybody have any questions for me? Because when I come back after the webinar is over, then I'm just going to do, like I said, 10, 15 minutes on putting in the spreads. And, obviously those of you that are clear on putting in the spreads, you don't need to hang around for that. Okay. So I will assume you guys are cool with everything. Also, just a heads up, hopefully you guys got to see the Jim Dalton presentation yesterday. That was great. And then ShadowTrader is going to host another one with him on February 21st at 4:15 p.m. after the close. And I'll send you guys an email probably a little bit earlier this time. I didn't send I sent the email a little bit late, but I'll send the email maybe on like Friday the 16th with the sign-in information. And there's nothing to register for. You can just sign in and go. All right. Okay. All right. I'm going to turn it over to Mr. Gillum over there. I'm glad to see you're wearing some Eagles colors there, Gillum.
Had to put them on for you, Peter.
Thank you. Thank you. You do know that they trounced the Patriots in the Super Bowl last Sunday. Are you familiar with that?
Game
Oh,
that
look
I've
at
ever
that. He
seen.
just ran away.
No, I'm here.
Okay. All right. Did you see, I just got to leave you with one last thing. Did you see that commercial for the insurance company? It was like a little cartoon, like blue face, like a head or something. And it said, if you cheat on your car insurance, you can go to jail. But if you cheat at football, you can sleep with a supermodel. I couldn't believe they did that in a commercial. I thought that was great.
Missed
All right.
that. All right.
Yeah. All right. Scott's got the screen, and I will turn my mic. I'll turn my webcam off.
Okay.
And turn it over to Mr. Gillum.
I'm going to turn off mine so you can see what's down here in the bottom right. All right. We had a couple of things happen this week. One, that SPY put vertical that we had going, or the put diagonal we had going, came to the point where it was profitable once again. The first big downdraft in the market. Let me go back to the SPY here for a second. All right, the first big downdraft we had, first part of this week, afforded that losing trade, that losing diagonal that went to a vertical to become profitable. I took it off. I guess it was still the diagonal at the time. I took it off because of this big down whoosh, and we went from being a negative or a losing trade to a profitable trade. If you had the cojones, or whatever you want to call it, and held that all the way through till today.
Scott, this is a family show.
If you had the guts or the fortitude, okay, if you had the fortitude to hold it all the way through today and let that just go through, because it's kind of a small debit, it became a very large profit for you. You probably doubled your profit. We still made 50% on the trade, so I was very happy with that to take that off. Now let's go to the new trade that came on, which was Disney. Disney after earnings. Oops, Disney. I'll type it in right. Disney had great earnings. There were profits in parks, huge. Profits in materials, huge. Profits in their movie business, and they're getting a new director or a new tie-in to the people that did some of the Netflix movies, and their directors are going to do the new Star Wars movies that are coming out. So that's a big plus. Their BAMTech, which is their mobile phone kicker for ESPN, is going very, very well. Their Hulu was doing very well for them on their report, and it was a very uptone report. Market liked them after hours and pushed them. This is the candle that was right after. Here's the earnings. Here's the candle that came right after that. And unfortunately, I didn't look at my implied volatilities. As Peter said, they crush. Well, they didn't crush enough right after earnings, and I got stuck in here buying that diagonal, that long-dated long call, and the shorter-dated short call at this expanded implied volatility, and we crushed yesterday, and we came back up a tad bit today. So I put myself in a bad situation. Just to let you know, I had to do something this morning. Took that February to April call diagonal, dollar wide in the spreads, and I said, nope, I've got to get this back down to a manageable amount of money. So I took our February 111 short calls and I rolled it into the March 110s. Now I've got a calendar that's out there March to April. I've got 3 more iterations of rolling on that short call if I want for the calendar. It's still on the profitable side. The Greeks are still the way I want to set things up, which means I've got positive delta, I've got positive theta, and it's okay at this point. We just have to wait a little bit for some of that extrinsic value to bleed off. But how can we take advantage of where we are today underwater to our benefit? Well, if, and this is a big if Disney finds a bottom, and here's this old trend line from the earnings, it broke that today. If it finds bottom here at this point in time and starts to curl back up, I'm going to do what Peter does, and I'm going to sell a put vertical at a lower strike, down here around 100, down to 95. Add a little bit of margin with the thought that we're going to go back to the upside. Here's your 200. This dotted line I put in here because it's one that a lot of companies are now using, and that's the 100-day moving average. It's simple. So if we capture this 100-day moving average, which is a big if, I will look to add margin and a put vertical to the underside of this trade. So right now that call diagonal is okay. It's running fine. The extrinsic value will bleed off on the 110 short, and the 110 long is out there into April. We've still got around 65 to 70 days to go on that. All right, so that's the only trade that's on now. Things that I'm looking at the put side on a couple of the put verticals, put diagonals, not verticals, put calendars or diagonals on a couple of issues. One being McDonald's. Let me push up McDonald's. McDonald's is absolutely on the downside. RSI has gone from overbought to now, overbought to the point where it's oversold, and it hasn't turned the corner yet, and the MACD has started to go even further as this trend continues. So it would have been nice to put it on today, but this is my level that I'm looking at, the 153.25. So I'm looking at a possibility of a put diagonal there on McDonald's. Second on my hit list is Adobe. Same situation. Crossed over on its 20-period moving average. It's now a big drop today in the market, a whole big drop today, down to the 50. Here's the 100, here's the 200. This one looks like a good setup for another put diagonal. Activision Blizzard. Same situation. Below the 50, 100, 200. RSI is going from nearly overbought to neutral, now going negative, and the MACD is starting to increase its push to the downside. These have all moved hard in the last couple of days. Last one on my list to look at is, well, two of them, is Kohl's department stores. Although retail is going to be out there an economic report in the next couple of weeks, I want to see if this thing flattens out. If it flattens out, I'd like to look at a put diagonal on this one, along with a possible bear call that adds some credit for these levels up here, which I do not think it'll get back to between now and probably mid-March. And I'll give you one more on that retail side, is Coors. I wanted to put this on the other day, big downdraft after earnings, but this big drop today with this market, I'm concerned to where this is going to find bottom. Is it going to find bottom at the 100, or is it going to find bottom back here and try to fill this gap that it had in the prior earnings? So that's on my radar. So those that are on my radar: McDonald's, Mike Charlie Delta, Adobe, Alpha Delta Bravo Echo, Activision, Alpha Tango Victor India, Kohl's, Kilo Sierra Sierra, and Coors, Kilo Oscar Romeo Sierra. I'm cracking.
Oh, Scott, it's kind of crackly. I've been trying to get you on Hangouts.
Yeah, I saw that.
Yeah.
I'm done.
Okay. Perfect timing.
I don't know why, because I've only got this open with the webinar and the platform. So
are you on the Mac or the PC?
I'm on the PC again.
Huh. Okay, I don't know.
Got to be my cable because we've got ice jams all over the place.
All right.
Back to you, dude.
Okay, no problem. All right, so I said that I would talk about spreads a little bit. So, for instance, the SPX would be a good example, right? And let me just switch the screen share over to me. Hold on one second. Give me 1 second. Okay. So for instance, let's say that we were here I purposely, what's that?
Before you get going, I know I'm crackly and the sound is bad. If you had a problem seeing the charts, go to the replay because that should be good. So
Yeah, usually the replay is okay. Yeah.
the replay will be good. So I apologize for that for everybody.
All right. Thanks, Scott. So let's go out to Feb 16, right? And just so you know, those of you that are a little bit new to options, the difference between these two is that one is AM settled and one is PM. So you have your weeklies that are always in the PM. And then because it's an options expiry on February 16th, right? Because Feb 16 is an options expiry, here's the two different versions here. Hold on. Oh, why my whiteboard's not working? All right, there we go. Well, I just wanted to point out that these two here, one of them expires in the morning and one expires in the evening. So the first one is AM and the second one is PM. All right. So obviously I'm always interested in the PM because you want that extra bit of time. But let's just look at the call side here. All right, let's look at the call side. So we have a butterfly on the call side, which is 2760, 2765, 2780. And because volatility is jacked up, we were actually able to put this on, period, for a credit. We wouldn't be able to put this on at all in normal volatility. In normal volatility, you can't go like 100 points higher in the SPX and put on a broken wing. It's just not happening. You might get like 10 cents for it or whatever. So very simply, to put on the call side, all we do is we know that the mid strike is 65, right? And we just right click and say analyze buy and choose butterfly. Got it? And then the butterfly comes up here, and I'll move my ugly mug off so you guys can see. All right. And then we just have to change the strike. So you get the text and it says 60, 65, 70. So you change the third one out here. Excuse me, 60, 65, 80. And you change the third strike to 80 like that. And you can see now it's only a 20-cent credit, and it was like a 40 to 50-cent credit when we put it on. All right. So that's the broken wing part of the butterfly. Very simply, you just start with a straight butterfly and then you move this strike or this strike however you want it. And if there's space, if the space between these strikes, think of it this way, it's like a big space like that, a small space, is bigger, then it should trade for a credit. All right? Okay? Bruce, on the COG trade, we're long puts, like at the money where we bought it. So it doesn't matter how much it's down. We only lose the price of the put. And the difference between like whatever, 30 cents from 32.30 down to 32, right? Because we have a long put at 32, expiring tomorrow. So that's why there's no management of the COG trade, right? If you buy stock and you buy a protected put at the same time, what's the point of managing it? There is no management. You know, that's basically it. All right, so that's the call side. And then on the put side, that one's pretty easy. It's just a straight butterfly, right? So we know that we did 2625, 2600. So it's very simple. We just go to the 2600 strike and we buy butterfly. 20, and we just move our strikes out. And down here, we're at 25.75. All right? Yours shows a debit of 5 cents on what? Well, you obviously have something different. That's why. All right. Now, if we want to do unbalanced, let's say that we thought that the S&P was not going to come down below, say, 1800, which is crazy, right? I don't know if this will work with unbalanced. Buy unbalanced, right? Butterfly. We can get rid of these. And notice that here, even though the width of the strikes is the same, you get a credit, right? Because you're buying 1, selling 3, and buying 2. And thus, when you get down below the bottom strike, you can't lose any more money, but inside of it, you can lose much more after you cross the mid strike. Makes sense, right? Because you're +1 right up to the mid strike. So think of it as +1, -1. That's the vertical. And then you're short 2 verticals. Does that make sense? Because you're like this. Let's say you're going down on the puts. It's actually, and they're equidistant. So do you see how when you come into this middle area here, you start to lose money? But the point of this spread is to generate a credit. And again, that's really easy to put on. You just, like I said, right click and choose unbalanced. And then sometimes what we do is we even break it out. Like we do unbalanced broken wing. All right. Okay. Does that make sense? And that's basically it. And then you have to understand that these particular spreads will probably sometimes take a little bit longer to fill. You got to just kind of sit there for a little bit. And if you see that price is only moving a little bit, not too much, then you're in good shape. You'll probably get a fill. It's only if price goes far away from it that things will change a lot. So you're in good shape there. Okay, I'm trying to go through my notes of all our trades of what else we put on that might be a little bit esoteric. Really, the BWB and the unbalanced is really it. I mean, other than that, it's, you know, put vertical, call vertical, regular butterfly. You know, oh, and then there's the iron butterfly as well, right? So let's say, no, you don't use market orders, Wayne, on it's all limit. It's all limit on option spreads. You never do market. You always do limit at price, okay? Now, let's say that we thought that the SPX, or let's go back to that NVIDIA idea. Right, the NVIDIA idea is a good choice, right? Notice how this is called iron butterfly because we're short at the same exact strike, put and call. Remember, iron implies both sides, put and call. Like iron condor means what? That's a typical spread that a lot of people are familiar with. You sell a call vertical on one side of the chain and you sell a put vertical on the other side of the chain, and that's called iron when you have it on both sides. And it's called iron condor because a regular condor would be buying a call vertical and selling a call vertical and staying all along one side of the chain. Put condor would be on the other side. Iron condor is when you're using verticals on both sides of the chain. So, and it's interesting actually that in iron condor, you should really think of it as short iron condor because you're selling both of the verticals, right? So for instance, Wayne, like in the NVIDIA is a good example, and we'll just do it again. We'll clear it. If we think that tomorrow NVIDIA is going to peg around 250 and not move, it would probably make sense to do sell. And again, and here it gets kind of weird because there is no iron butterfly choice. So you have to choose iron condor because that's what's going to give you the strikes on both sides. And notice that here and here, the two that we're selling, which is this one and this one, we want both of those to be the same strike. So notice that I move that one to 250. And let's say I want to be 20 points wide, then I know that on the call side, I go 270. And on the put side, I go down to 230. So now I'm short put and call at 250, and I'm long call at 270, and I'm long put at 230. That makes sense, right? That's that. NVIDIA, Wayne says, how did you get where you are? Are we selling? Well, it goes along with my comments earlier that because they're gapping up big, the stock is trading at 242.58 after hours. There's a good chance that maybe it opens somewhere around here in the 250 area. And if it opens in the 250 area, my thought is that it probably goes sideways and doesn't do anything from there. And if the volatility starts to crush, well, that's good, because think about it. The stock could stay between 230 and 270 in order for you to make money. Now, obviously, that 20 wide is not going to get you 1650 at the open. Let's see what it would be like at the money. See, we can't even price it because they've already started to skew all this because of the earnings. So we can't really tell what this would be. I mean, the 245, hold on, 217. Yeah, see, they're still showing this like at the money. I mean, I guess it would be like the 217.50. But yeah, it would kind of still work. Like, look, let's do it here. So this is what it would be like at the close. We'd have to look at what the 217.50 strike would be. And then minus 20, right? Would be what, 197.50. And over here, it's 237.50. So see, it's only 13 at the money, because that strike that we looked at, the 250, it kind of moved out, you know. So anyway, that's the quick primer on how to put in spreads. Wayne, do you have any other questions, or anybody else, in terms of like how do you put on a spread, how do you work the platform, whatever? Yes, exactly. Whatever credit you get, Wayne, you are not expecting it ever to go to zero. That's not going to happen. Think about it. The stock would have to stop right on 250 on the dot for it to go to zero. And even then, it wouldn't go to exactly zero. It'd be impossible to close it for zero. It wouldn't happen. I mean, I guess it would close for zero if the actual final print at 4 p.m. was exactly 250. Then obviously those at the monies would go out worthless. But yes, the game is for the volatility to compress. And for instance, if you sell it for 15 or whatever, you start buying it back at 14, at 13, at 12, whatever. And anything like that is really a home run. And the beauty of the iron butterfly, the way it usually works, is that you want to be taking advantage of that vol, right? And you're also taking advantage of the fact that those trades generally don't go against you very much when the stock moves, especially when you've got like 7, 8, or 9 days left, which I think is always a sweet spot to put those on for the theta burn, like let's say 9 calendar days out. So you see the price start to move, and let's say you sold the spread for 15, but usually what will happen is it won't go against you very much. Like maybe it'll trade 15.20, 15.30, then it'll come back down. It just kind of expands and contracts, because think about it. You're short a vertical on one side, you're short a vertical on the other side. So as one is gaining against you, one is gaining for you. All right. Bob, what is your question? Let's see here.
Yeah, Peter.
Yes, sir.
Yeah, Wayne's got a question of what type of margin risk are you putting on for that day? And that's really immaterial, because what you're doing is you're not looking to have this thing go out and be handled by the broker. You want to do it yourself. So if it starts to go against you, as Peter said, you take 1 off, then you take 2 off, then you take 3 off, then you take another 1 off.
Right. Exactly. Exactly. There's not a lot of risk there, Wayne, because remember, like, let's say it's a 20 wide spread and let's say you got $15. Well, your risk is that 5, and your risk is only 5 if it blows out hard towards one direction and goes past the outside of the strikes. You see what I'm saying? So that also implies, which is important to understand, that what you want to be doing with this type of spread is you want to be looking at, like, for instance, the NVIDIA is really an excellent example. Like, let's say you could put it on for the 15 or 16. What you want to be looking at is where are the areas of support or resistance where there's a good chance that the stock won't go. Like, the best case scenario for this type of trade is when a stock is range bound. And, like, for instance, you would put it on, like, let's say here and here. And you would have the outer strikes of the iron butterfly in here, like outside, just right here. So you would have good confidence that what the stock is going to do is it's going to bounce around in this area. And who cares where it finishes? Wherever it finishes at the end of the week, you'll be fine. All right? All right. Does anybody else have any questions? If not, we'll wrap it up. And Scott and I are working on the daily update right now.
And I'll be sure to get your replay so that you can see what I was looking at for charts.
Randall, is the SPX trade too expensive to put on tomorrow? Maybe, maybe not. If we bounce, Randall, and the problem is this: if we bounce, then the spread is going to get more expensive, because think about it. Volatility will come down, you'll get less for the calls, and the put butterfly will cost more. As if volatility drains, the put butterfly will definitely cost more. So that's the thing. I would say, Randall, if you can get it on for the same price that we did, give or take, say, no more than 25 cents or something on the put side, I would say. I wouldn't sell the calls for 15 cents. Not sell, but I wouldn't buy that for 15 cents. But you know what I mean? Give or take, maybe on the calls, a nickel or whatever. I wouldn't take less than 40 cents on the calls. And on the puts, again, I mean, if instead of $1.40 you have to pay, $1.60, okay, so be it. I think it's still a pretty solid trade. Remember, you're getting the butterfly on the put side cheap because of the high vol. If you think that vol is going to come in the next week, and I believe it will a little bit, the spread will expand and we'll probably trade around that level. So at some point next week, I believe that the spreads will be able to be sold for $3 or more. I think it will make sense. All right. All right. Without further ado, I think that is going to do it for today's webinar. We'll wrap it up. Scott is always at sgillum@shadowtrader.net, and I'm, of course, at Ask the Shadow. And we wish you good trading and good night.
Good night.
All right. Good. Take care, guys.